Have you ever wondered why most traders fail, even after following all the so-called expert advice? Why do trading gurus make it look so easy, yet 90% of beginners lose money? If you've asked yourself these questions, you're not alone, and that's exactly why I wrote this video. Inside, I'm going to reveal the #1 lie trading gurus don't want you to know, a truth that can change the way you approach the markets forever. This isn't about secret indicators, fancy strategies, or overnight riches. It's about understanding what really drives trading success, avoiding hidden traps, and building your own edge in the market. By the end of this video, you'll have the knowledge, mindset, and practical tools to stop chasing gurus and start trading smarter. Before we dive in, make sure to subscribe to my channel for extra tips, real trading examples, and insider strategies that I don't share anywhere else. Now, let's uncover the truth that the gurus hope you'll never find out. Chapter 1. The Guru Illusion. Have you ever noticed how some trading gurus make everything look effortless? One day, they're in a small apartment. The next, they're showcasing luxury cars, exotic vacations, and screenshots of triple-digit gains in a single week. Their social media posts, flashy YouTube videos, and expensive courses give you a clear message. Trading is easy if you just follow my method. And like many beginners, you might have thought, if I can just find the right mentor, my life will change overnight. That thought, while enticing, is exactly what keeps most traders trapped in the endless cycle of hope, disappointment, and loss. The truth is, the guru image you see is largely an illusion. Trading is rarely glamorous, rarely simple, and rarely fast. Most people don't understand that the lifestyle you see is carefully curated content designed to sell an idea, not teach reality. When you peel back the glossy videos, screenshots, and testimonials, you'll see a world filled with missed trades, sleepless nights, emotional swings, and countless mistakes. The gurus rarely talk about these things, not because they don't experience them, but because they know that admitting them would shrink their audience and their income. One of the most dangerous myths these gurus propagate is the idea that successful traders are born with some secret talent or exclusive knowledge. You've probably heard phrases like, "I've been trading since I was a kid," or "I discovered a system that guarantees profits." These statements create a false narrative that success in trading is about luck, innate skill, or secret formulas. In reality, trading is a skill that anyone can learn, but it requires patience, discipline, and consistency, not miracles. There's no magic button that will make you profitable overnight, and believing otherwise sets you up for failure. Another layer of the illusion is the emphasis on complex strategies, indicators, or secret systems. Many gurus sell courses promising a step-by-step blueprint to riches. Beginners, eager for a shortcut, often invest hundreds or thousands of dollars in these programs, hoping for a life-changing return. But here's the harsh reality. No strategy works 100% of the time. Markets are unpredictable, influenced by news, psychology, and countless variables that no one can control. The successful traders you admire don't rely solely on systems. They rely on adaptability, experience, and most importantly, emotional control. They understand that losing trades are inevitable, and that protecting capital is far more important than chasing every opportunity. It's also important to understand the marketing tactics behind these guru stories. Limited time offers, flashy testimonials, and screenshots of massive returns are psychological triggers. They're designed to create urgency and fear of missing out. When you feel like you're behind or missing the secret, you're more likely to make impulsive decisions, like buying a course or following a trade blindly. Most gurus profit more from selling hope than helping you actually succeed. Recognizing this pattern is the first step to breaking free from the guru illusion. A critical aspect of breaking the guru illusion is understanding the role of mindset in trading. Many beginners focus solely on strategies, charts, and technical indicators, believing that these are the keys to success. While these tools are useful, they are secondary to mental discipline.
A trader with a strong mindset can navigate losses, avoid impulsive decisions, and stick to a plan. A trader without discipline, no matter how many systems or secrets they possess, will consistently lose. The gurus rarely emphasize this because it's harder to sell mindset training than it is to sell a secret system. Equally important is the concept of self-reliance. The most successful traders are not constantly chasing the next guru or following someone else's trades. They develop their own edge by observing markets, analyzing outcomes, and refining their strategies over time. This process requires patience and humility. Accepting that mistakes are part of the journey, that losses are inevitable, and that no one has all the answers is liberating. Once you embrace this mindset, the temptation to blindly follow gurus diminishes. Many traders fall into the trap of comparing themselves to these success stories they see online. They measure their progress against the snapshots of wealth and success curated by others, forgetting that those snapshots hide years of struggle, failure, and learning. Comparison is toxic in trading because it creates unrealistic expectations. Your journey is unique, and your results will be shaped by your effort, discipline, and the lessons you learn along the way, not by imitating someone else's life. It's also worth noting that trading education itself can be misleading if you don't approach it critically. There are countless books, blogs, and courses claiming to reveal the ultimate strategy or insider secrets. While education is essential, it's only valuable when paired with practical experience. Reading about strategies will never replace the lessons you learn from live trading, mistakes, and risk management. The guru illusion thrives on selling theory without emphasizing the hard work required to turn knowledge into skill. Breaking free from the guru illusion starts with skepticism and awareness. When you see a trading course promising overnight wealth, pause and ask critical questions. Who is profiting from this? What are they not telling me? Is this method adaptable to changing markets, or is it just a template that will eventually fail? Developing this critical mindset not only protects your capital, but also empowers you to think independently, a trait shared by consistently successful traders. Another factor to consider is the social element of trading communities. Many gurus encourage followers to join private groups or channels where they can share secrets or get alerts. While some of these communities provide value, most are structured to reinforce the illusion and keep traders dependent on the guru. Successful traders use communities differently. They seek knowledge, but they don't rely on them blindly. They learn from multiple perspectives, test strategies themselves, and only adopt methods that align with their risk tolerance and understanding. Finally, it's important to internalize a simple truth. There is no shortcut to success in trading. No guru, no course, and no secret system will replace the time, experience, and discipline required to become profitable. The illusion persists because people want to believe in easy solutions, but those who succeed are the ones who focus on learning, practicing, and developing self-discipline. This is not glamorous, it's not sexy, but it's real, and it works. By the end of this chapter, I want you to walk away with clarity. The guru illusion is powerful, but it is only an illusion. The real keys to success are mindset, discipline, and consistency. Stop chasing shortcuts. Stop measuring yourself against curated images of success and start focusing on building your own trading foundation. Your results will reflect your effort, patience, and ability to learn, not the promises of any guru. Trading is a journey, not a spectacle. It is messy, it is challenging, and it requires persistence. But once you understand the truth behind the guru illusion, you gain freedom. The freedom to take control of your trading journey, make informed decisions, and create real and sustainable success. This chapter is your first step in breaking free from deception, understanding reality, and embracing a path that will genuinely transform your trading life.
Chapter 2. The Hidden Cost of Advice. Imagine this. You're scrolling through social media or watching YouTube, and you stumble upon a trader claiming to have made $50,000 in a single week. The next thing you know, they're offering a course, a mentorship program, or a daily trading alert. It all sounds tempting. After all, who wouldn't want to shortcut their way to financial freedom? You feel a sense of urgency, maybe even fear of missing out, and before long, you hand it over hundreds, maybe thousands of dollars, hoping that this advice will finally unlock the success you've been chasing. This scenario is painfully common, and yet most traders fail to realize the true cost hidden behind advice. The first thing to understand is that not all advice is equal. Some is valuable, yes, but much of it is designed to sell, not educate. Trading is a business, and like any business, there are people whose primary goal is profit. Sometimes their profit comes from your losses, but often it comes from selling hope. You need to be extremely cautious about the advice you take, because the wrong advice, especially when applied blindly, can destroy your capital faster than bad luck ever could. Following someone else's trades without understanding their rationale is one of the fastest ways to lose money, and yet it is one of the most seductive traps for beginners. One of the most common pitfalls is the one-size-fits-all mentality. Many trading gurus sell strategies or systems as if they are universal solutions. They tell you, if you follow this, you'll win, without considering your unique situation, risk tolerance, or even the current market conditions. The truth is, trading strategies work differently for different people. What works for a professional trader who spends 8 to 10 hours analyzing the markets may not work for someone trading part-time or without the same emotional control. Blindly following advice without adapting it to your own style is like trying to fit a square peg into a round hole. It rarely works and can lead to catastrophic losses. Another hidden cost of advice is the psychological effect it creates. When you place a trade based on someone else's recommendation, you are immediately giving away a part of your own responsibility and control. You start to rely on external validation instead of developing your own judgment. Over time, this dependency weakens your decision-making skills, making you more vulnerable to emotional reactions like fear, greed, and panic. Many traders blame the market or their own bad luck, but the reality is that the true damage often comes from surrendering control to someone else. It's also worth noting that advice is based on hindsight, not actionable insight. Many gurus present trades that worked perfectly in the past, creating a compelling story of success. What they rarely show are the trades that failed, the losses that piled up, and the constant adjustments they had to make. Following such advice in real time is extremely risky because the market is never static. A strategy that worked perfectly yesterday may not work today, and blindly copying someone else's past trades can be disastrous. The hidden cost here is not just financial, it's the erosion of confidence and the development of unrealistic expectations. One key to avoiding these pitfalls is learning to critically evaluate advice before acting on it. Ask yourself, does this advice align with my trading plan? Can I understand the rationale behind it? Have I tested it in a controlled environment like a demo account before risking real money? Learning to filter advice in this way is crucial because not every piece of guidance is inherently valuable. By questioning and testing advice, you turn it from a passive recommendation into an active learning tool. This approach shifts the focus from blindly following to building knowledge, which is ultimately what creates sustainable success. Risk management is another area where the hidden cost of advice becomes painfully clear. Many traders take guidance without considering how much of their account they are willing to risk. A recommended trade that sounds perfect on paper may expose your capital to unnecessary danger if it doesn't fit your risk parameters. When traders ignore risk management, even a winning strategy can lead to ruin. The cost of advice is compounded when you fail to assess the risk involved. This is why understanding your own limits and establishing rules for position size, stop-loss placement, and account exposure is non-negotiable. Emotional attachment to advice can also be dangerous. Once you've committed to a mentor or guru, you may find it difficult to question their guidance. You start defending trades that go wrong, rationalizing mistakes, and ignoring red flags. This emotional bias clouds judgment and prevents learning. A successful trader treats advice as data, not doctrine. They extract what is useful, adapt it to their strategy, and remain detached from outcomes. By doing so, they protect both their capital and their mindset. It's important to also understand that advice often comes with hidden incentives. Many gurus earn more when you buy a course, subscribe to alerts, or join a paid group than when you actually make profitable trades. Your success is not always their priority, your investment in their knowledge is. This is not necessarily malicious, but it is a reality that every trader needs to be aware of. Treat every recommendation with a critical eye, and always ask, who benefits if I follow this advice? Your capital is too valuable to hand over without questioning motives. Another common form of hidden cost is information overload. In today's digital age, advice comes from every direction: YouTube videos, blogs, podcasts, forums, newsletters, and social media feeds. While access to information is beneficial, consuming too much unfiltered advice can paralyze decision-making. Beginners often try to apply multiple strategies at once, resulting in inconsistent performance and mounting frustration. Learning to filter, prioritize, and act on advice that actually align with your goals is essential to avoid this invisible drain on your progress. Practical application is where the true value of advice is revealed. Knowledge alone does not produce results. Application does. Many traders read countless books, watch endless tutorials, and attend seminars, yet they failed because they never bridge the gap between theory and practice. Testing, iterating, and learning from your own mistakes is what transforms advice into a usable skill. Blind adoption without application is like buying a gym membership and expecting to get fit without ever working out. The hidden cost is wasted time, wasted money, and most importantly, wasted potential. Developing self-reliance is the antidote to the hidden cost of advice. This doesn't mean ignoring mentors or refusing guidance. It means using advice as a tool to strengthen your own decision-making. A self-reliant trader asks questions, tests ideas, and continuously adapts strategies based on real-time learning. Over time, this builds confidence and resilience, allowing traders to act decisively in any market condition. Self-reliance transforms advice from a potential liability into a stepping stone for mastery. It's also crucial to differentiate between advice that teaches and advice that sells. Teaching focuses on principles, reasoning, and adaptability. Selling focuses on outcomes, promises, and results. The best traders learn from mentors who emphasize understanding the why behind a strategy rather than blindly following rules. This distinction separates temporary success from sustainable success. The hidden cost of advice is often masked by flashy results, but understanding the underlying principles ensures long-term growth. Finally, recognizing that mistakes are inevitable reduces the hidden cost of advice. Even with careful evaluation and testing, you will make trades that fail. Accepting this reality and treating mistakes as lessons, not failures, shifts your perspective. Advice is valuable when it contributes to learning, but becomes costly when it encourages dependency, fosters overconfidence, or undermines judgment. By maintaining awareness, applying critical thinking, and practicing disciplined risk management, you can extract the benefits of guidance while avoiding its pitfalls. The hidden cost of advice is real, pervasive, and often underestimated. But once you understand it, you gain a powerful advantage. You learn to question blindly, act deliberately, and value your own judgment over external promises. You stop chasing others' trades and start creating your own path. This chapter is about awakening to that reality, realizing that advice is a tool, not a guarantee, and that the true cost lies in your willingness to accept it without thinking. By the end of this chapter, you should see advice for what it really is, a resource to learn from, not a shortcut to success. You will begin to evaluate information critically, manage risk intelligently, and develop self-reliance. These skills are more valuable than any secret strategy a guru can sell, because they equip you to thrive in any market condition. Trading is a personal journey, and your ability to navigate it successfully depends on how wisely you use the guidance available to you. Understanding the hidden cost of advice is a turning point. When you recognize that following others blindly can harm more than help, you begin to think independently, trade confidently, and make decisions that reflect your knowledge, experience, and risk tolerance.
You stop chasing others' trades and start creating your own path. This is where the journey toward real trading mastery begins, a journey where your success is defined not by the gurus you follow, but by the trader you become.
Chapter 3: Emotions are the real enemy. Have you ever wondered why some traders, even with the best strategies and tools, fail again and again, while others, seemingly with the same resources, succeed? The secret doesn't lie in charts, indicators, or systems. It lies in the human mind. Emotions are the silent enemy of traders. Fear, greed, and ego are invisible forces that influence decisions more than any strategy ever could. Most beginners underestimate this, believing that success comes solely from technical knowledge. The truth is, trading is a battlefield of psychology, and the strongest weapon isn't a secret system, it's emotional control. Fear is perhaps the most obvious enemy. It creeps in quietly at the wrong moment, often disguised as caution. Imagine seeing a perfect trade setup, but instead of executing it, your mind freezes. You start imagining all the ways it could fail. What if the market reverses? What if I lose my money? This hesitation costs more trades than almost anything else. Fear is not just about losing money, it's about losing control, losing confidence, and losing the opportunity to grow. Traders who fail to recognize fear often let it dictate their actions, exiting trades too early, missing profits, or avoiding trades entirely. Understanding fear and learning to manage it is the first step to taking control of your trading. Greed is the opposite, but equally dangerous. It whispers promises of just a little more profit and tempts traders to ignore their rules. Greed manifests in overtrading, risking too much on a single trade, or holding positions far longer than they should. You might see a profitable trade and think, if I just wait a bit longer, I can double my gains. But markets are unpredictable. That extra moment can turn a winning trade into a losing one. Greed clouds judgment and blinds traders to risk, causing mistakes that no strategy can prevent. The most successful traders learn to recognize greed, set profit targets, and stick to their plan without exception. Controlling greed is about discipline, patience, and the humility to accept that profit is a process, not a sprint. Ego is a subtler, yet equally destructive emotional enemy. It often shows up after a winning trade, making traders believe they are invincible. The ego says, "I was right, the market was wrong," or "I don't need to follow my rules today." This overconfidence can lead to reckless decisions, ignoring risk management, or taking trades outside your strategy. Ego fuels impulsive trading, turning small wins into significant losses. Unlike fear and greed, which are easy to identify in the moment, ego creeps in over time, slowly eroding a trader's discipline and judgment. Awareness is the key. Recognizing when ego influences decisions allows you to recalibrate and return to rational thinking. Emotional control doesn't mean suppressing feelings. It means recognizing them and not letting them dictate your actions. Every trader experiences fear, greed, and ego. The difference between consistently profitable traders and those who fail is how they respond. Successful traders build systems and routines that minimize emotional interference. They understand that emotions are signals, not instructions. A surge of fear might indicate risk is too high, while excitement may signal an opportunity, but neither should automatically dictate your actions. Training your mind to observe without reacting impulsively is a skill that pays far more dividends than any technical indicator. One practical way to manage emotions is through journaling. Keeping a detailed trading journal allows you to track not only your trades, but also your emotional state during each trade. Did fear cause hesitation? Did greed make you overstay a position? Did ego convince you to ignore your rules? By reviewing these entries, you start to recognize patterns in your behavior, which is the first step toward correcting them. Emotional awareness transforms abstract feelings into concrete data, giving you the ability to make adjustments and improve consistently. Another key method is developing a clear set of rules and sticking to them.
A trading plan is not just about entries and exits, it's a tool to neutralize emotional influence. When you have predefined rules for trade size, stop loss, and profit taking, your mind has less room to let fear or greed take over. For example, knowing that you will exit a trade if it hits a 2% loss removes the temptation to hold in hope or panic. Rules provide structure, and structure helps your mind remain calm in a chaotic market. Discipline is the bridge between strategy and emotional control. Mindfulness and meditation are also highly effective tools. They teach you to observe thoughts and emotions without judgment, creating mental distance from the market's chaos. Traders who practice mindfulness find that fear no longer paralyzes them, greed no longer tempts them excessively, and ego no longer drives reckless decisions. Mindfulness trains your brain to remain present and respond rationally rather than react emotionally. Over time, this practice builds a foundation of psychological resilience that allows you to navigate volatile markets with clarity. Sleep and physical health play a surprisingly large role in emotional control. A tired, stressed, or unhealthy body amplifies emotional responses. Traders who neglect these aspects often experience heightened fear, impulsivity, and irritability. Consistent sleep, exercise, and nutrition are not luxuries, they are essential tools for maintaining emotional stability. Treating your body with respect directly impacts your mental clarity and ability to stick to your trading plan, reducing the influence of fear, greed, and ego. The social environment also affects emotions. Discussing trades with friends, online forums, or social media can amplify emotions rather than calm them. Hearing about other traders' big wins can trigger envy or greed, while stories of losses can fuel fear. Successful traders learn to filter external noise and focus on their plan, progress, and learning. They create an environment that reinforces rational thinking rather than emotional reaction. Emotional mastery often starts with controlling what you allow into your mind. Risk management is intertwined with emotional control. Fear and greed thrive in the absence of proper risk management. When you know exactly how much you are willing to lose on each trade, fear loses its power and greed loses its pull. Stop losses, position sizing, and diversification are not just technical tools, they are psychological shields that prevent emotions from dictating outcomes. When risk is controlled, decisions become rational, not reactive. Understanding and implementing risk management is one of the most practical steps you can take to neutralize emotional sabotage. The consequences of ignoring emotions can be severe. Even the most brilliant strategy can fail if emotions dominate decision-making. Traders often blame the market or claim bad luck, but the underlying cause is usually emotional mismanagement. Fear causes missed opportunities, greed causes overexposure, and ego causes reckless trading. Recognizing these patterns in yourself and actively working to counteract them is what separates consistently profitable traders from the majority who fail. Emotional mastery is not optional, it is fundamental. Awareness, structure, and practice are the three pillars of emotional control. Awareness allows you to recognize emotional triggers in real time. Structure through rules, journaling, and risk management provides a framework to act rationally. Practice through repeated application and mindfulness strengthens your ability to maintain control under pressure. Together, these elements create resilience, consistency, and confidence in trading. They are more valuable than any secret indicator or system ever could be. Trading is often presented as a numbers game, but the reality is that numbers alone do not win trades. Your mind does. Charts, strategies, and algorithms are tools, but your ability to stay calm, disciplined, and rational under pressure is the true determinant of success. Understanding this fundamental truth, that emotions are the real enemy, is a turning point in any trader's journey. Once you grasp it, you stop blaming the market, stop chasing short-term wins, and start building sustainable success. By the end of this chapter, you should have a clear understanding that emotional control is not optional. Fear, greed, and ego are invisible forces that will sabotage your trades if left unchecked. The good news is that they can be managed with awareness, discipline, risk management, mindfulness, and self-care. The traders who consistently succeed are not those with the flashiest strategies or the most complicated charts. They are those who have learned to master themselves. Trading is as much about psychology as it is about numbers. The charts may guide you, but your emotions will decide your outcomes. Recognizing this reality allows you to approach the market with humility, patience, and confidence. Emotional mastery turns trading from a gamble into a skill-based profession. And once you understand that the real battle happens inside your mind, you gain a level of power that no guru, indicator, or system can ever take away. Emotions are the invisible hand that moves your decisions, but with knowledge, practice, and discipline, you can turn them from enemies into allies. The mastery of fear, greed, and ego is not a final destination. It is an ongoing journey. Every trade becomes a lesson, every mistake an opportunity to refine emotional resilience, and every small success a reinforcement of disciplined behavior.
Chapter 4. The Truth About Easy Money. Have you ever seen those flashy social media posts promising massive profits in just a few days? Turn $500 into $5,000 in 1 week, or learn my secret strategy and never work again. These promises are everywhere, and they look irresistible, especially if you're struggling to make consistent gains. The allure of easy money is powerful. It appeals to our desire for instant gratification, financial freedom, and a life without stress. But here's the harsh truth. In trading, easy money is almost always an illusion. The market does not owe anyone quick riches, and chasing this illusion is a surefire way to fail. The first step in understanding the myth of easy money is realizing that the stories you see online are often carefully curated. Social media and marketing platforms thrive on success stories. They show the few trades that went exceptionally well while hiding the dozens or even hundreds that failed. These snapshots create a distorted reality. When you see someone posting about a $10,000 profit in a week, you rarely see the years of losses, the sleepless nights, the failed strategies, and the emotional toll it took to reach that point. Most traders fail long before they ever see these kinds of gains, and most overnight success stories are actually the result of years of hidden effort. One of the most dangerous aspects of the easy money myth is how it shapes expectations. Beginners often expect to see immediate results, and when reality doesn't match the promise, frustration sets in. This frustration can lead to impulsive decisions, overtrading, and reckless risk-taking. Instead of building consistent habits, traders chase the next big win, hoping that one trade or one system will magically change their financial situation. The truth is, the market rewards patience, discipline, and consistent execution far more than it rewards chasing unrealistic shortcuts. Another point worth understanding is the role of compounding in trading success. Profitable traders rarely make their fortunes from a single explosive trade. They build wealth gradually through a series of small, controlled, and consistently profitable trades. Compounding is the secret engine behind long-term success. By protecting capital, managing risk, and gradually growing positions, traders turn small gains into significant results over time. This approach may seem slower and less glamorous than the idea of easy money, but it is far more reliable and sustainable. The market favors consistency over luck, and traders who respect this reality tend to succeed while others fail chasing overnight riches. The desire for easy money often leads traders to neglect risk management. When you believe that huge profits are just a trade away, you may be tempted to risk too much capital on a single position. You might ignore stop-loss rules, double your position size, or chase volatile trades in hopes of a windfall. This behavior is the fastest path to account blowups. No strategy, no matter how promising, can withstand the impact of reckless risk. Understanding that there are no shortcuts means accepting that protecting your capital is far more important than chasing a single extraordinary win.
Psychology plays a massive role in the pursuit of easy money. The excitement of imagining life-changing profits triggers emotional responses, greed, hope, and overconfidence. These emotions cloud judgment and encourage impulsive behavior. Traders who fall into this trap often experience cycles of elation followed by despair. They celebrate big wins as proof of their skill, only to experience crushing losses that wipe out months of progress. The easy money myth feeds this emotional roller coaster, making trading feel like gambling rather than a disciplined skill. It's also important to understand the market's nature. Financial markets are inherently unpredictable and influenced by countless variables: economic data, political events, corporate news, and human behavior. No one can control these forces, and no system can guarantee profits. Promises of fast gains ignore this reality. Successful traders accept uncertainty, plan for multiple outcomes, and adapt their strategies accordingly. They focus on probability, risk-reward ratios, and disciplined execution rather than chasing the illusion of instant wealth. Education is a crucial tool in dispelling the easy money myth. Many beginners are drawn to trading by stories of overnight fortunes, but they lack the foundational knowledge to navigate the markets effectively. Learning about market mechanics, risk management, and trading psychology equips you to recognize realistic opportunities and avoid traps. Education transforms hope into strategy, replacing the desire for easy money with an actionable, informed approach. Knowledge is power, and in trading, it is the difference between short-lived luck and long-term success. Mentorship, when approached correctly, can also help combat the illusion of easy money. The right mentor teaches principles, reasoning, and adaptability rather than promoting guaranteed profits. They show the mistakes, failures, and learning curves involved in trading. By observing how experienced traders handle losses, manage risk, and stick to their plan, beginners learn that success is a gradual process, not an instant reward. The focus shifts from chasing windfalls to mastering skill, discipline, and patience. Time horizon is another critical factor. Many traders operate with a short-term mindset, expecting gains within days, weeks, or months. This approach aligns with the promise of easy money, but rarely produces sustainable results. Profitable traders think in terms of months and years, not days. They understand that wealth creation in trading is about compounding small, consistent gains and avoiding catastrophic losses. Patience becomes their greatest ally, and the obsession with immediate profits fades as they embrace a long-term perspective. Financial literacy is also intertwined with realistic expectations. Traders who understand leverage, position sizing, and margin requirements are less likely to be seduced by the promise of fast money. They recognize that high-risk strategies can produce quick gains, but at the expense of potential ruin. Educating yourself about these principles allows you to assess opportunities critically, balance risk and reward, and avoid chasing trades that appear too good to be true. Knowledge of the mechanics behind the markets protects your capital and your mindset. The concept of opportunity cost is often overlooked in the pursuit of easy money. Time spent chasing unrealistic trades or following hype could be better invested in developing skill, refining strategies, or studying market behavior. Every impulsive decision driven by the desire for quick profit represents a loss of opportunity to build long-term competence. Successful traders treat time as a resource and invest it wisely, focusing on learning and growth rather than instant gratification. Behavioral finance offers additional insights into why the easy money myth is so seductive. Humans are wired to seek rewards and avoid pain, a bias that makes the promise of fast gains highly appealing. Social proof, scarcity tactics, and confirmation bias all reinforce the allure of easy money. Recognizing these cognitive biases helps traders step back, evaluate opportunities rationally, and avoid emotional traps. Awareness of psychology is as important as technical skill, as it prevents you from being manipulated by marketing and hype. Consistency, more than anything, separates traders who succeed from those who fail chasing fast profits. Executing a well-defined trading plan repeatedly, learning from mistakes, and refining strategies is far more profitable over time than attempting high-risk trades for immediate reward. Markets reward disciplined behavior and punish impulsive decisions. Easy money may look attractive, but it is fleeting, whereas consistent, thoughtful trading builds enduring results. Another important point is that trading is not just about making money, it's about controlling losses and managing risk. Traders who obsess over easy money often overlook this. They focus on potential gains without considering the potential losses. This imbalance creates vulnerability. Successful traders focus on risk-adjusted returns, ensuring that every trade aligns with their plan and risk tolerance. By doing so, they create a sustainable path to profitability that is independent of market hype or false promises. It is also vital to understand the emotional toll of chasing easy money. Constantly seeking quick wins creates stress, anxiety, and emotional instability. This mental strain can affect decision-making, health, and overall quality of life. By abandoning the pursuit of instant wealth and embracing a structured, patient approach, traders experience less stress, greater confidence, and improved mental clarity. Emotional well-being directly impacts trading performance, making patience and discipline even more critical. Finally, the truth about easy money is simple but powerful. There are no shortcuts. Trading success comes from knowledge, practice, discipline, risk management, and emotional control. The overnight riches stories are exceptions, not the rule, and most of these exceptions are heavily curated narratives. Understanding this reality allows traders to approach the market with clarity, set realistic goals, and focus on long-term growth rather than fleeting hype.
Chapter 5. Systems can't replace skill. In the age of technology, it's easy to believe that success in trading comes from finding the perfect system. Automated bots, indicators, alerts, and ready-made signals promise to make trading simple and profitable. Many beginners are drawn to these tools with the hope that they can remove the hard work, emotional strain, and uncertainty from trading. You might have thought, if I just find the right software, I won't have to think anymore. This is a seductive illusion and one that can be dangerously misleading. Systems, no matter how advanced, cannot replace skill, judgment, and experience. They are tools, not guarantees. One of the most common mistakes traders make is relying on signals without understanding their rationale. A system may generate a buy or sell alert, but it does not know your risk tolerance, your account size, or your personal strategy. Blindly following signals is like taking directions from a GPS without knowing the destination. If the market behaves differently than expected, you are left unprepared to respond. This dependency creates a false sense of security, where traders believe that software will protect them from losses, when in reality, it can amplify mistakes if misused. Skill, awareness, and adaptability are what protect a trader, not automated alerts. Even the most sophisticated systems are limited by their design. Indicators and bots are based on historical data and predefined rules. They cannot predict news events, geopolitical shifts, or sudden market reactions. A strategy that worked perfectly in the past may fail in the present because markets are dynamic and ever-changing. Experienced traders know this and treat systems as guides rather than authorities. They use tools to support decisions, not to replace thinking. The key difference between a profitable trader and someone who fails is not the tool they use, but how they interpret and act on the information it provides. Developing skill requires more than following rules. It requires understanding context. Two traders using the same system may have drastically different results because one understands when to override signals based on market conditions, while the other follows every alert blindly. Skill is the ability to analyze, interpret, and make decisions in real time. It is built through observation, practice, and reflection. Without this foundation, no system can make you consistently profitable. Tools may help, but they cannot substitute for the judgment developed through experience.
Another important point is the psychological impact of over-reliance on systems. Beginners often experience frustration, confusion, and loss of confidence when a system fails. They may blame themselves, the software, or the market, creating emotional turbulence that affects future trades. Experienced traders approach systems with humility. They know that tools are fallible and that mistakes are opportunities to learn, not reasons to panic. Emotional resilience is built by understanding that systems assist, but the mind must remain in control. It's also worth noting that the learning curve for skill-based trading is steep but immensely rewarding. When you develop the ability to read the market, interpret price action, and make informed decisions, you become independent of signals and alerts. This independence is liberating. You no longer feel trapped by the need for the perfect indicator or the latest bot. Instead, you gain confidence in your own judgment, which is far more valuable than any software. Skill transforms trading from a game of following instructions into a craft that you control. Skill is closely tied to adaptability. Markets evolve, trends change, and volatility shifts. A system is static, designed with assumptions that may not hold over time. Profitable traders are not those who follow rigid rules. They are those who can adjust, innovate, and respond intelligently to new conditions. They combine systems with analysis, intuition, and experience to make decisions that are informed but flexible. Systems alone cannot teach adaptability. This comes only through practice, observation, and reflection on successes and failures. Risk management is another area where skill surpasses systems. A trading bot may calculate optimal position sizes based on historical volatility, but it cannot account for your personal risk tolerance or emotional comfort. Understanding how much to risk on each trade, when to take profits, and when to cut losses requires judgment that is built over time. Traders who rely solely on systems often ignore these nuances, leaving themselves vulnerable to losses that could have been avoided with thoughtful analysis. Skill allows you to integrate tools into a broader risk framework rather than blindly trusting automation. Even indicators, which are often marketed as magical solutions, have limitations. Moving averages, RSI, MACD, and other tools provide information. They do not provide certainty. Markets respond to human behavior, news, and sentiment in ways that no formula can predict. Skill allows a trader to use indicators intelligently, combining multiple signals, reading patterns, and considering context before making a decision. Without skill, indicators are like arrows pointing in random directions. They may help occasionally, but they do not replace understanding. An overlooked aspect of skill is intuition, which is developed through repeated observation and experience. Over time, traders begin to recognize subtle cues in price action, volume, and market behavior that systems cannot capture. Intuition is not mystical. It is pattern recognition informed by practice. Traders who cultivate intuition can anticipate movements, assess risk, and make confident decisions even when systems fail. Skill, therefore, is not just about technical knowledge, it's about training your mind to see opportunities and threats that no automated tool can detect. Practical experience also teaches timing, which is critical. A system may tell you to enter a trade, but skill allows you to choose the right moment based on the market's rhythm. Timing decisions can make the difference between a profitable trade and a loss. Systems cannot feel market sentiment, understand trader psychology, or sense subtle momentum shifts. These are human abilities developed through observation, repetition, and reflection. Mastering timing is a skill that no software can replicate. Another point worth emphasizing is that dependence on systems can stunt growth. Beginners who rely solely on tools may never develop the analytical skills needed to navigate the markets independently. They may experience occasional wins when the system aligns with the market, but these wins are often inconsistent and fragile. True mastery comes from learning to think critically, evaluate information, and make informed decisions without relying on external crutches. This self-reliance is what separates professionals from hobbyists. Education and study amplify skill. Understanding market mechanics, economic principles, and trading psychology equips you to interpret system outputs intelligently. Knowledge allows you to question, adapt, and refine strategies rather than following them blindly. The combination of skill and education is what allows traders to use systems effectively, turning tools into aids rather than crutches. The more you understand, the less you are at the mercy of automation or external advice. Trading is fundamentally a human endeavor. Markets are driven by human behavior, emotions, and psychology. Systems can model behavior to an extent, but they cannot replace human judgment. The most successful traders understand this and use tools as supplements rather than replacements. They know that mastery comes from integrating knowledge, observation, adaptability, and emotional control. Systems assist, but they cannot teach skill. They are instruments, not replacements. By the end of this chapter, it should be clear that relying on systems alone is a trap that can lead to false confidence, inconsistent results, and failure. Tools are helpful. They can provide information, automate repetitive tasks, and support decision-making, but they cannot replace the judgment, adaptability, and skill built through practice and experience. The real advantage comes from mastering the craft of trading, understanding markets, managing risk, controlling emotions, and developing intuition. Systems are as effective as the trader using them. Skill is the foundation of long-term success. It allows you to navigate uncertainty, make informed decisions, and respond intelligently to dynamic markets. It transforms trading from a mechanical process into a thoughtful, strategic endeavor. The traders who thrive are not those with the latest indicators or bots. They are those who have invested the time, effort, and discipline to develop skill. Systems are tools, but skill is power. Trading is a craft, and every trade is an opportunity to refine your skill. Systems can guide, but they cannot replace judgment. They can assist, but they cannot replace intuition. The illusion that automation can substitute for skill is one of the most dangerous myths in trading, and recognizing it is a turning point. Once you understand that skill, not systems, drives consistent profitability, you gain independence, confidence, and the ability to navigate the market on your terms.
Chapter 6. Your edge is you. Have you ever wondered why some traders, with no secret systems, no fancy indicators, and no high-priced mentors, consistently make profits, while others lose despite following every guru tip? The answer is simple but profound. Your real edge in trading is not a software, a strategy, or a magic formula. It is you. Your mindset, discipline, adaptability, and willingness to learn are the only things that can give you a lasting advantage in the market. This chapter is about understanding that the most important tool in trading is not external. It lives inside your mind. Most traders spend their energy chasing external solutions, systems, bots, signals, or courses, believing that these will give them an edge. But here's the truth. No system is perfect, no course can guarantee profits, and no guru can trade your account for you. The market is unpredictable, and conditions are constantly changing. Strategies that worked for one person or one market may fail for another. The only constant you can control is yourself. When you realize this, a shift happens. You stop seeking shortcuts and start investing in your own growth. Your edge is built through self-discipline, emotional control, and continuous learning. Self-discipline is the cornerstone of your edge. It is what allows you to stick to your plan even when fear, greed, or ego is whispering in your ear. It is what ensures that you follow your rules for entry, exit, and risk management rather than making impulsive decisions. Discipline is not about rigidity. It's about consistency and integrity in your trading practice. A disciplined trader may not have the flashiest strategy, but over time, their consistency compounds into reliable profits. Discipline transforms potential into results, and it is cultivated through daily habits, journaling, and reflection. Learning from mistakes is another critical aspect of developing your edge. Every trader, no matter how experienced, makes mistakes. The difference between successful traders and those who fail is how they respond to these errors.
Beginners often react emotionally, blaming the market, system, or external circumstances. Successful traders respond analytically. They review their trades, identify what went wrong, and ask themselves, what can I do differently next time? Mistakes become lessons, and lessons become improvements. Over time, this feedback loop creates an edge that no system or guru can replicate because it is uniquely yours, shaped by your experiences. Adaptability is the third pillar of your personal edge. Markets are living, breathing systems influenced by countless variables: economics, politics, human behavior, and sentiment. Conditions shift constantly, and rigid adherence to a single approach is a recipe for failure. Traders who develop an edge learn to adapt their strategies, adjust position sizes, and respond to changing volatility. Adaptability requires awareness and experience. It is not something you can buy or copy. By observing patterns, recognizing market behavior, and learning to pivot, you gain an advantage that allows you to survive and thrive when others struggle. Emotional mastery is closely linked to your edge. Fear, greed, and ego are the invisible forces that destroy many traders' accounts. Mastering these emotions gives you clarity and control. When you can recognize fear before it paralyzes you, greed before it clouds judgment, and ego before it makes you reckless, you gain a distinct advantage over the majority of traders who react impulsively. Emotional mastery allows you to execute your plan consistently, even under pressure, giving you an edge that no indicator or mentor can provide. Your edge also comes from developing a trading routine that suits your personality, schedule, and goals. Successful traders create a framework that includes preparation, analysis, execution, and review. They know what to focus on, how to manage risk, and how to measure performance. This routine reduces emotional volatility, builds confidence, and allows you to make rational decisions instead of reacting to every market movement. By customizing your approach to fit your strengths and weaknesses, you create a system where you are the central advantage. Another important element is continuous learning. Markets evolve, and traders who stop learning fall behind. Reading, studying, analyzing trades, and observing the behavior of others are all ways to expand your knowledge. But learning is not just academic, it is experiential. Every trade you take, whether it wins or loses, provides data and insight. Traders who analyze this information, refine their strategies, and adapt improve over time. Your edge grows as your knowledge, experience, and confidence accumulate. Unlike any external system, this edge compounds and cannot be copied. One of the most empowering aspects of realizing that your edge is you is the freedom it creates. You no longer feel dependent on signals, courses, or mentors to succeed. You start trusting your judgment, instincts, and preparation. You understand that setbacks are temporary, lessons are permanent, and consistent practice creates results. This mindset shift transforms trading from a reactive, stressful endeavor into a confident, strategic activity. You are no longer at the mercy of the market. You're a participant who controls risk, adapts, and makes informed decisions. Risk management is inseparable from your edge. Even the best mindset or strategy can fail if you ignore risk. Successful traders understand that protecting capital is more important than chasing wins. They calculate position sizes, set stop losses, and diversify exposure. Your edge comes from knowing your limits, respecting the market's uncertainty, and making decisions that prioritize survival and sustainability.